Hi everybody. A very happy New Year to everybody, and 恭喜发财 for those who are celebrating this week. We're back for our live market commentary, the first one for this year in 2024. And as usual, we're here to talk about the latest developments in the financial markets and also to share our views about them. I'm Albert, and I'm the Deputy Country Manager here in Malaysia. I will be your host for today's market commentary. And as usual, we are joined by Stephanie, our Chief Investment Officer. Hi there, Stephanie. How are you?
Good, good. Hi, Albert. Hi, everyone. Happy New Year. And yeah, 恭喜发财. This week, I think a lot of us are celebrating Chinese New Year. So let's see
Yes.
what the market brings afterwards.
Yes, and before we go into the Chinese New Year, I just want to, we are in the new year of 2024, and we have had a lot of economic action packed into the starting few weeks of this year. Perhaps I want to start off today's session by looking back at what happened just last week, right? We had the Fed meeting, and that was where they held interest rates last week. This was, I believe, for the fourth straight meeting in a row. But what they did differently was that they signaled that they were open to cutting interest rates. So this was quite a change. But what the Fed chair Jay Powell said was that they are unlikely to reach a level of confidence come March, which is when the markets were expecting a cut in rates. So we've seen since the end of around October, November last year, where markets rallied very, very strongly on the back of expectation of rate cuts. This has continued to some extent into the year itself. What do you think, Stephanie, about this expectation for rate cuts driving market returns?
Yeah, I mean, obviously the Fed determines the interest rate, which is what we call the risk-free rate. And the level of risk-free rate actually matters for most risky assets. So starting from bonds to corporate credit to equities, I mean, to even cryptocurrencies. So that's why all of us care a lot about what the Fed and Chairman Powell has to say at each Fed meeting. Now, I guess at the kind of most recent Fed meeting, the Fed actually pushed back upon the market's expectation for a March rate cut. Also, Chairman Powell had an interview just a few days ago in the U.S. And during that interview, he also says that basically, I mean, data determines the Fed's path going forward. And he thinks that still, I mean, data is quite strong. Therefore, the case for a March cut is not there. A few months ago, when the market was actually starting to price in the start of the rate cut cycle in March, we actually also pushed back on that expectation in the sense that if you look at the Fed's mandate as a dual mandate central bank, meaning that they would like to maintain economic growth via full employment, and at the same time also target lower and stable inflation. So what do we mean by that? Number one, on the growth front, the Fed will try to like change their monetary policy so that they to avoid basically a deep recession or systemic crises like what happened in 2007 and also as recently in COVID. If we look at the data on that front, labor market is actually still very, very strong. If you look at the US unemployment rate is still below 4%. And historically, if you look at recessions, that tended to coincide with a spike of unemployment rate. Also, if you look at the longer term average of unemployment rate, it has been kind of around 5 to 6%. So, I mean, we're still far, far away from, I mean, even just historical average unemployment. So, I won't go a lot deeper into the labor market, but this is an area that we've kind of maintained for some time now that is structurally strong due to some distortions from COVID. Now onto inflation, and I think this has been the issue that has that the market has been trying to grapple with for the past 18 months or so. And equities actually rebounded quite strongly as this inflation started from the first quarter of 2022. By this inflation, I actually mean the inflation number or CPI number coming down on a sequential basis. So that's still an ongoing process. And if you remember about 12 months ago, developed markets, including the US, was facing very, very high inflation, almost to the tune of 9% year-on-year change. Now, today we're looking at somewhere around 3.5% to 4%, depending on which inflation measure you look at. But it's a long way from the 9% that we had just a year ago. So the disinflation process is in place. However, if you compare where we are right now to the Fed's target, there's still some work to do. So the Fed's stated target is 2%. Chairman Powell himself has actually said during the interview a few days ago that they will start cutting rate if they are confident that the inflation path is on its way to 2%. So they don't actually necessarily have to wait till the inflation number to go to 2% to start cutting rates, but they need to be reasonably confident. So I think the path of inflation going forward in the next few months is actually quite important, because if inflation actually gets stuck at current level and perhaps even spike up due to, let's say, a heightened tension in Middle East, that actually doesn't give the Fed a lot of comfort in cutting interest rates. So from now till I guess kind of second quarter, which is where the market is pricing in the first rate cut now. There's still a few months to go, so a few more inflation prints to go. And I think those would be pivotal in determining whether the Fed would actually start cutting interest rates in the first half of this year.
Hmm. On a related topic, yeah, Stephanie, you mentioned about strong economic data that has come out more recently. We had last Friday very strong new jobs created or added in the month of January itself. We have had strong wage growth coming in. Unemployment rate remains at very low levels, about 3.7%. We had GDP growth for the US coming in at last quarter at about 3.3%, far ahead of what economists were projecting.
Mhm.
And so essentially, this strong economic growth, given that we're seeing that, does that reinforce the case for a soft landing? We've talked about soft landing in our previous sessions,
Yes.
and it is a pretty rare occurrence for it in given historical attempts at creating a soft landing. So do you think that's still, is that the base case right now, given that strong data is coming out, things doesn't seem to be too wobbly, with the exception that, last week we had some slight concerns of a potential SVB scenario coming up again,
Yeah.
in the case of, the New York Community Bank Corp, concerns around the commercial real estate in the US itself. So what do you think about that, Stephanie?
So I think if you kind of look at different aspects of the economy, you get slightly different answers. And if obviously the employment data is very strong, and we've actually mentioned quite a few times why we expect perhaps U.S. and labor market to still remain quite strong unless like the economic activities actually slow down quite meaningfully. I think if you look at kind of the January data by itself, there's quite a bit of distortion. So the headline numbers actually looks very, very strong. There are some one-off exceptions to the January number. So I think we need to look at a 3-month rolling basis. But even if you look at that, also, as I mentioned, it is quite strong, right? So where the economy is weaker is actually in the manufacturing side. So one data point that we've been tracking for quite some time now is the PMI, the Purchasing Managers Index. So if you look at the PMI, it's separated into manufacturing and also service. On the manufacturing side, US was actually in contraction for almost a year now. And however, on the service side, because of the strong labor market, because of the strength in consumer, that's still holding up very, very nicely. So there has been a bit of a two-speed economy going on in the US, and given that the US economy is actually much more skewed towards consumption and in both goods and services, that side of the economy actually was able to pull up the manufacturing side. We've seen some signs of manufacturing stabilizing and even rebounding in the past few months, but it's still kind of below the threshold where we can say that is for sure expanding. And for us to be very confident in terms of the US achieving a soft landing, I think two things need to be in place. Number one is that inflation actually gets back to close to 2% target. And number two is that manufacturing actually start to recover. So I think we're seeing signs of improvement towards in those two goals. But the threshold or the metrics that we cited have actually not been met. And I think the market obviously now is pricing in a soft landing in the sense that equities are actually in full recovery, and also bond market is also pricing in a pretty significant pace of interest rate cuts. So I think we have to, as investors, we have to think about kind of what are the base case scenarios, what are different risks, and more importantly, what the market is pricing in. The risk now is that the market is quite, unanimous is in thinking that the Fed can actually achieve a soft landing. And I mean, even the Fed itself actually thinks that they are close to achieving that soft landing. So if there are some external shocks that derail the path in terms of growth and inflation, then I think the market is actually quite mispriced for those particular outcomes. And just a reminder, if you think kind of beginning of the year in 2023, we were having the same market commentary, and back then, I think the consensus both for Wall Street and also perhaps on Main Street was that the US is going to a recession. And of course, the most anticipated recession actually never came. So just be a bit aware of the narrative out there, and what are some of the different scenarios that can play out. I think one important kind of development to watch out for is outside of the US, what are the other economies, like major economies, doing? And if we monitor, when we monitor the data for Europe, for example, and for China, growth in those areas are actually relatively a lot weaker than in the US. So if Europe slips into a recession and China recovery fails to take hold, then on a global scale, growth would actually slow down even more. And I guess the US is obviously relatively stronger, but still, I mean, it would be affected by global environments as well.
Hmm. Thanks, Stephanie. For those of you who have questions on what we're talking so far, whether it's on the markets or even on Stashaway itself, just feel free to post them in the comments bar, and we'll get to it. I guess the one piece that I wanted to touch on next is on the fact that we just released our 2024 outlook, which is the second part of it. The first part of it was released at the end of 2023, and the start of this year, 2 weeks back, we released our second piece for the 2024 outlook. So maybe tying in the different elements that we have talked about earlier, Stephanie, about the US economy, where interest rates are going, the risks that are happening. Perhaps you could share with our listeners here some of the key takeaways that we shared in at least the second part of the 2024 outlook.
Yeah, so we've actually had quite a number of in-person client events throughout the region. We had some client events in Hong Kong, Singapore, and I guess after Chinese New Year, I'll be meeting with some clients in Malaysia and Thailand as well. So during these physical outlook events, we actually presented our views on the US and also on other parts of the world. In terms of I guess where people show a lot of interest is what are some of the regional themes that we can be excited about or kind of be bullish on for the next I guess not just for the short term, but for the next decade to come. And here we highlight two regional stories that we think are probably more immune to what's going on globally, but they have their own domestic growth and structural change stories. The first one is actually Japan. And Japan has done very well, I think, in 2023. But if you look at Japan's equity market from a 30-year perspective, it is still not yet at where it was about 30 years ago before the bubble actually burst. And Japan was actually suffering from a deflation problem for the past 30 years. And it seems that with the recent increase in inflation, the Bank of Japan is ready to declare that the war versus deflation is finally over. That is a very, very significant change for the Japanese economy because actually inflation helps to, promote consumption and also investment in an economy. So central banks all know this, and of course, they talk about inflation all the time, but what they fear more is actually deflation problem because they actually don't have very good tools to fix deflation. And if Japan can really get out of deflation, which stimulates growth and investment and consumption, I think there's a long way to go for the Japanese story. The corporates have very, very low return on equity compared to global equity markets, which means that there is a lot of room for Japanese companies to improve their return on equity. A lot of these are not because the Japanese companies are very badly run, but it's just the fact that they haven't been, for example, returning cash to the shareholders. They haven't been able to find good investment opportunities. So I think this is a very, very important change. And for long-term investors, I think Japan is a market that's worth paying close attention to. The second market or second region that we're very excited about is actually India. Now, India has also actually performed very, very well in the past 2 decades. If you look at the annualized return of India, it actually slightly outperformed even the S&P, the US equities. And a lot of people ask us, is it too late to get into India, right? If you haven't been investing in India, are you cashing the top? And here, we try to actually look at India from a inversion point of view, meaning that if we look at what's been holding back India's growth in the past decade, we have these actually changed for the positive in recent years. Because we all know that the India story is very, very obvious. It's a population growth story. Its population actually surpassed China in last year, and it is like the biggest world economy with sizable kind of growth in population in the next 2 decades. So I think that the growth story or positive story is well known. We try to look at the negative story to see if we can actually get even more positive, and if these kind of derail these growth constraints are lifted. And here we think there are two major constraints to India's growth historically. The first constraint is infrastructure. So for all of us who have been traveling to India, I think we all know that there is a lot of room for improvement. And encouragingly, we're seeing the government stepping up its investment in recent years. So we think this is the start of a trend. The Indian government also has a relatively low debt to GDP ratio. So that means that they can actually afford to spend more on improving infrastructure. The second issue that foreign investors have been struggling with in India is high inflation and a depreciating currency. And I think on this front, actually, the Indian central bank has started to target inflation a few years ago, and we're seeing the result of that. India inflation actually, on average, went down from 8% to about 5% in recent years, and this is good for the currency. So I think net, we're getting even more positive for India because we think that the constraints that they had in the past are changing for the better. And anecdotally, if you look at kind of foreign companies, in the past 12 months, we've seen foreign investors going back into India again, not just within the financial markets, but also making real investments in factories, in operations, in companies, etc. So I think this is a long-term story that it's here to stay. So I think that is a very exciting development for all of us as investors.
All right. Yeah, thanks, Daphne. That actually answers one of the questions from our audience, Christoph here, who was asking about the prospects of investing within India itself. I guess, Stephanie, the next question would be, given how what you've talked about India, where there's a structural element to it. If you flip it to the other round on China itself, right, which is going through its own problems.
Mm.
So for example, deflation is property issues, and the Chinese government is propping or trying to support or increase confidence in the market. Does that mean one should be selling from if you have Chinese holdings to sell out from China and into India itself, because both lie within that emerging market thesis.
Yeah, so I mean without understanding a portfolio, it's very hard to give kind of, I guess, specific advice. Of course, there is so both China and India have significant weights in emerging markets indexes and also in global equities. So I guess our view is that on a structural basis, we're more positive on India's story, like the India growth story, than China. I mean, if you think about China's kind of like China has gone through a very, very fast growth phase during the 2000s. And right now is dealing with some structural issues. For example, they're trying to rebalance the economy from property, from kind of the I guess the big kind of software technology companies into newer industries. So, for example, electronic vehicles, new energy, healthcare, et cetera, et cetera. So this is actually for the good of the long-term trajectory of the country. However, in the short term, you would see some pain because why? If you look at the equity market of China, obviously the bigger cap companies have a bigger weight, and bigger cap companies are the old industries, right? They are the banks, they are the property conglomerates, they are the Alibabas and Tencents, right? But when the Chinese is trying to rebalance that economy into electronic vehicle producers, for example, these electronic producers are actually starting from much smaller, a smaller scale. So as you kind of shrink one part of the country, which is a much bigger weight, and try to increase the smaller kind of parts of the country, then in the interim, there's a certain mismatch. And I mean, we're right now going through that interim. So at some point, the newer industries would be able to take over and drive the economy forward again. But I mean, that is something that's kind of much more down the road.
Mm.
So I think right now we're going through this sort of structural change in China, which may not be kind of the best for equity investors. However, having said that, of course, like the Chinese equity market is very, very depressed in terms of valuations, and we've seen a lot of, I guess, efforts from the Chinese government to restore confidence, to boost the equity market, to boost investments. And historically, when the Chinese authorities try to stimulate the market, it tends to rebound. So I think I mean, it may not happen on the first time, second time, but ultimately they are trying to protect kind of downside risk for the country and for its economy. So I think at some point the economy will start to bounce back, and that's when I guess the stock market will also bounce back as well. However, I mean, we look at the data. So when we look at data for China, we focus on, for example, the inflation data, the leading economic indicators. I mean, those are still not turning around. So for us, I mean, China remains a market weight in our portfolio because it's cheap, but we're yet to see that sort of turnaround in the economy yet.
All right, so there you have it, our views on both China and India. We've gone past a little bit past our time, so if any of you have further questions based on what we've talked about today, or if you might have questions later on, just do feel free to write into us at support@stashaway.com, and we'll be happy to address any questions you might have. But yeah, that's it for today's market commentary. For those of you who are celebrating Chinese New Year, 恭喜发财 again, and I guess we'll see you in the next market commentary session. Thank you, everybody. Thank you, Stephanie.
Thank you, Robert. Thank you, everyone, and have a great Chinese New Year.
Bye bye.
Bye bye.